Hello, party people. Today, we are going to be talking about oil and gas reporting. Now, this is it's a topic that's very near and dear to my heart because I've spent a ton of time doing research on it, assisting taxpayers in reporting and planning, and also assisting other tax firms in the preparation of returns for taxpayers who are invested in oil and gas wells through the partnership structure. Now, what we're talking about here is not royalties from oil and gas. It's not, publicly traded partnership interest for oil and gas. It is when the taxpayer actually invests into the partnership that is going to drill the oil out of the ground. Now, typically, when a taxpayer puts money into a partnership and become a partner in a partnership, when they get that K-1, it's generally a passive activity unless they materially participate in the activity. Now, this is a huge downside when you're talking about taxpayers who are putting money into a partnership and intending to generate a large loss, like you see with some real estate partnerships, right? That's the whole intent, is to generate large losses that they can use on the return. But most taxpayers won't be able to use those large losses because, again, it's going to be deemed to be a passive activity. The flip here with the oil and gas partnership is that when a taxpayer puts money into a working interest in an oil and gas partnership, doesn't matter how much time they spend on the activity, it is deemed to be non-passive, right? No matter how little hours or how few hours they spend on it, they can just put the money in, bam, non-passive. Now, there are a couple of requirements to get to that working interest status. The taxpayer generally is going to see on their K-1 that they're marked as a general partnership. That's because they're not allowed to have limited liability, but many of these partnerships still have like indemnification agreements or insurance to help protect the taxpayer, so that way they don't lose more than their initial investment, okay? So people will put money into these things because they generate large losses in the first year. And many of them, it depends on your experience. I know some tax professionals who have had clients put money into oil and gas wells and they never make any money. And then I've had others where they put money into oil and gas wells and they make a ton of money, in addition to the first year benefit of seeing those large losses. Okay. So where do the large losses come from? Well, when your client puts money into the oil and gas partnership, the partnership is going to take that money, and before they can even start drilling, they've got to hire engineers to come out to the site to check to see, hey, is it possible that there's oil under the ground? They do a preliminary drilling to see how much oil is under the ground. Is it commercially feasible to actually drill here? There are a bunch of other costs that they have to incur when they are starting the activity up. Now, many tax professionals are aware of startup costs, the rules for startup costs, where if you incur costs to start up your business before you're actually able to go out and create and sell a viable product, whether it's tangible property or intangible property like a service or something like that, those costs have to be amortized over a period of time. Now, that same rule would normally also apply to all of those costs that are incurred by the oil and gas partnership, but for the exception in 263A, which says that these intangible drilling costs, these costs that you are incurring to start up your drilling operation, those are allowed to be deducted in the year they are paid or incurred. Okay? So, because we don't have to amortize those over a period of time, we get an immediate write-off. And that, in addition to the normal operating expenses of that oil and gas operation in that first year, often generates a huge loss, right? For every dollar you put into that oil and gas partnership, oftentimes you end up seeing 70 to 90% of that dollar being a first year deduction or a first year loss item. So you put in 100K, you might get $80,000 of deduction out of that partnership. Now, obviously, it's not a dollar for dollar tax savings, right? But it is a way to help to mitigate your tax liability while also putting money into the energy sector, into an alternative investment. And many investment advisors like that kind of thing, right? You want to have some of your clients' portfolio in that, alt sector or in that energy sector, especially in the US today. We have a lot of programs where they're trying to push more companies to start drilling oil here in the United States. So you've got a partnership. We determine that if it's a working interest, it's automatically non-passive. we've determined that in the first year, we get massive losses that come out of the partnership. The thing that trips practitioners up is the way the losses are reported, okay? So on the K1, when you look into, I think it's part 2 or part 3, basically on the right-hand side of the first page of the K1, you will find that the taxpayer is going to have some ordinary trade or business income or loss in that first year. Normally it's a loss, sometimes it's a little bit of income up there in box 1. And then down in box 13, that is where your intangible drilling cost deduction lives. That is an ordinary deduction item, and it's going to give the taxpayer a loss on their return. It'll flow right over to Schedule E, page 2, and it's going to help to offset their income. Because again, non-passive activity, large loss from intangible drilling costs, okay? But then that's where, like, the simplicity of the reporting ends. And everything from here becomes a nuanced discussion, right? So once we get over the left-hand side of the right part of the K1, we start to get into our box 14 item, which is our net earnings from self-employment. It could also be a net loss from self-employment. Now, normally, if a taxpayer is going to invest into a partnership, oftentimes they end up being a limited partner. And so under Code Section 1402, I think it's A13 or C13, I can pop it in the video here. There's an exception where it says, hey, if the taxpayer is a limited partner in the partnership, then their share of the net earnings or net loss from that partnership are not subject to SE tax because they are a limited partner by their function. Now, there's a whole thing that's being litigated through the courts right now of what that limited partner exception means. Can I just have the box checked that says limited partner and no self-employment tax, or is there more to that? But we're not going to cover that here in this video today because the client's not a limited partner. In order to be able to be treated as though they have a working interest in the oil and gas partnership, to get the non-passive treatment, they have to be a general partner in the partnership. And so you'll see that general partner box checked on the K1, okay? So the partnership, it's drilling into the ground, pulling out the oil, selling it to a refinery. Guess what? That is a trade or a business. And so because the partnership operates a trade or business and the limited partner exception to self-employment tax does not apply, our earnings or loss from the partnership is net loss or net earnings from self-employment, which could create a self-employment tax liability or help to mitigate a self-employment tax liability. So the situation I was working with today, the taxpayer had a Schedule C that was showing $100,000 of net profit, which was going to be subject to self-employment tax. But because they put about, I think it was like 150 grand or so into this oil and gas partnership, they ended up getting a $125,000 loss. Guess what? $125,000 net loss from self-employment. So we fully offset our self-employment tax liability from our Schedule C. No 15.3% self-employment tax on our $100,000 of Schedule C earnings because of this investment. Now, when you look at box 14 on that K1, this is where people get tripped up. Usually that box 14 amount only shows the amount of loss in box 1. And the amount of loss in box 1 is often far smaller than the intangible drilling cost deduction that shows up down in box 13 of the K1. Now, why don't they include the box 13 intangible drilling costs in the net earnings and the net loss from self-employment? Well, it's because the partner, when they receive their K1, there is an election they can make to amortize the intangible drilling costs over a period of time. I believe it's about 5 years. Now, you don't have to do that, but the thing that you need to watch out for is that that is a net loss from self-employment item. It's just like if you get a K1 from a partnership that shows 179 expensing, that's not going to show up in box 14 as a net loss from self-employment because the partnership has no flippin' idea if the partner is actually going to be able to deduct the 179 expensing because there are limitations that are applied at the individual partner level. So that's why that number is not in there. But guess what you have to do as the practitioner? If the client is going to actually take that intangible drilling costs as a deduction in the current year and they're not going to amortize it, you need to increase their net loss from self-employment or decrease their net earnings from self-employment that you enter when you do the K-1 input. So you've got to combine the box 1 loss and the box 13 deduction together, even though that's not what box 14 shows. That's just how you have to do the reporting. That is what is required, okay? So people miss that all the time. And this preparer, when they had prepared this return that was sitting in front of me today that I was reviewing, they had not done that. So that was the first problem. So by doing this, we saved the client like an extra, I think it was like 10 grand or something like that in self-employment tax, which is a big deal, right? That's a huge cost to the client because we didn't understand the fundamentals of how the oil and gas partnership works. The next thing that I saw that was an error on the return that needed to be corrected was the AMT, okay? So under the federal tax system, we have the regular tax, and we also have, running at the same time, an alternative minimum tax system. And so under the AMT system, you have certain items that have to be added back to the regular taxable income to come to your alternative minimum taxable income, because they don't want wealthy people taking advantage of every single loophole under the sun and not paying any tax ever. So that's the purpose of AMT. And under AMT, there is an add back, or what they call a preference item, for excess intangible drilling cost deductions. And so this preparer had looked at the K-1 in the AMT section and they said, oh, there's a number here. That needs to be an AMT preference. They added it back. It created a $10,000 AMT liability. But here's the thing. If you don't understand how the excess IDC preference works, you're going to do the 6251 wrong for AMT calculations, because for independent producers, which the vast majority of your clients' investments into oil and gas partnerships are going to be independent production activities, meaning the partnership is only responsible for drilling the oil out of the ground, they sell it off to a refiner. If the partnership was doing everything under the sun related to the oil and they were processing it, refining it, and then selling it retail or wholesale, that would be a different problem, okay? But most of these partnerships are not doing that. And you can confirm that by having the client going to the investment advisor, getting the private placement memorandum, and in there it will define, hey, look, we are only drilling the oil out of the ground. We sell it off to a refiner who, kind of does the final production on that oil that we pulled out of the ground. For independent producers, the rules say that you do not have to make a preference adjustment under AMT for excess intangible drilling costs if the amount of the excess intangible drilling costs does not exceed 40% of the alternative minimum taxable income before applying the add back for the excess IDCs. So what this preparer had done is they had just slapped the whole number in as a preference item. But when you look at it, they found that I think the taxpayer's overall taxable income was around $400,000. 40% of $400,000 is, so for like $160,000, somewhere thereabouts. Okay. Yeah, about $160,000. So this taxpayer's excess IDCs did not exceed $160,000. So guess what? There is no excess IDC preference. There is no add back. And so when you take that out, like you're supposed to under that independent producer exception, then you don't have an AMT liability. So we saved 10 grand by understanding, how to do the reporting for net earnings and net loss from self-employment. And we saved another 10 grand or so by understanding that the excess IDC was not actually a preference add back in this case because of the independent producer exception. 20 grand that we saved this client. Just like that, okay? Going further from there, the taxpayer had made a SEP contribution for like $17,000. And the way that this had been entered into the software, because we had now said, hey, we have a large net loss from self-employment from this oil and gas partnership, totally offset the net earnings from self-employment, the software said, no, you can't make a contribution to a SEP because it's based on, for a self-employed sole proprietor, 20% of your basically net earnings from self-employment. But that's not That's not actually how that works, right? The software is making an assumption. The way it actually works is you look to the trade or business that the SEP was set up for, which was their Schedule C. It doesn't matter that we have all these other offsetting loss entities. We only look to the net earnings from self-employment from that entity that the SEP was set up for, which in this case was the Schedule C. And so we had to make a manual adjustment again here to be able to tell the software, no. Those net losses from self-employment from the other entities don't impact our ability to make a SEP contribution. So again, here we saved another $17,000 deduction by knowing that we had to make an adjustment in our software. And the same thing was relevant with the self-employed health insurance deduction. Again, software was freaking out, not allowing it. We had to make sure that it was assigned directly to that Schedule C to get it to qualify. So from the time the taxpayer or the tax professional sent me this return to review and I looked at all this stuff, we saved them like $25,000 to $30,000 just by knowing all of these rules. It's a huge deal, okay? Oil and gas partnership reporting, if your clients are going to put their money into it, you cannot just move forward assuming that you can do the reporting properly just based on what shows up on the K-1. You have to understand all of the underlying rules to make it work. So just please, for the love of goodness gracious, if you run across one of these K-1s, take the time to actually learn how to do the proper reporting for it.